For months, the headlines said the same thing. Artificial intelligence was the future. AI stocks were unstoppable. Tech valuations soared. Investors believed they were witnessing the birth of a new industrial revolution. Then, in a matter of days, trillions vanished. The US stock market plunged. The New York Stock Exchange opened to a sea of red. The Nasdaq dropped at a pace not seen in years. The S&P 500 erased months of gains in hours. What happened? Was it really an AI collapse? Or was the system already fragile, just waiting for a trigger? Tonight, we break down how an AI-driven boom turned into a financial panic, and why the crash may have been building long before the algorithms failed. The story begins not with a crash, but with euphoria. After years of low interest rates and stimulus, investors were searching for the next growth engine. When generative AI models exploded into public awareness, markets found their narrative. Companies tied to artificial intelligence saw their valuations multiply. Chip manufacturers, cloud providers, data centers, anything linked to AI, became a magnet for capital. Wall Street analysts began projecting exponential productivity growth. Hedge funds repositioned portfolios, retail investors piled into AI ETFs. Corporate earnings calls mentioned AI strategy more than revenue itself. The narrative was powerful. AI would automate industries, cut costs, replace labor, and create unprecedented profitability. Stock prices surged, not because profits had materialized, but because future dominance was assumed. And that assumption became the fuel. Behind the scenes, something more dangerous was forming. Margin debt climbed. Options trading hit record highs. Leveraged ETFs amplified gains. Algorithmic trading systems increasingly chased momentum. Institutional investors began concentrating exposure into a handful of mega-cap AI leaders. Market breadth narrowed. A small cluster of companies carried the indices upward. The rally became fragile. The higher prices went, the more investors believed they could not fall. Meanwhile, interest rates remained elevated compared to the ultra-cheap era of the 2010s. Borrowing costs were no longer negligible. Corporate debt refinancing became more expensive. But as long as AI stocks kept rising, no one cared. Crashes rarely start with a single cause, but they often need a spark. In this case, it was a convergence. A major AI firm reported slower than expected adoption rates. Another warned about rising infrastructure costs. A third admitted that training new models required exponentially more capital than projected. Then came regulatory pressure. Governments began questioning AI safety, data privacy, and monopolistic dominance. Investors suddenly realized that scaling AI was not frictionless. Earnings projections were revised. Stock prices dipped modestly at first, but in a leveraged system, modest dips can become violent. Once the first wave of selling began, algorithms accelerated it. High-frequency trading systems detected momentum reversal and began shorting. Stop-loss orders triggered automatically. Margin calls forced liquidations. The very systems designed to optimize efficiency amplified instability. AI stocks dropped 10%, then 20%, as valuations collapsed. Index funds, heavily weighted toward AI giants, dragged the broader market down. Panic spread beyond technology. Banks exposed to tech lending saw their shares fall. Venture capital funding froze. Private equity portfolios were marked down. Within days, the narrative shifted from temporary correction to systemic risk. Why did an AI correction turn into a full-blown market crash? Because the financial system had become interconnected. Pension funds held AI-heavy index funds. Retail traders used margin. Hedge funds used derivatives. Sovereign wealth funds allocated billions to US tech. When AI valuations fell, balance sheets weakened everywhere. Credit markets tightened. Corporate bond spreads widened. Startups reliant on constant funding faced liquidity crises. Investors who once believed AI would generate limitless cash flow now questioned whether the revenue justified the valuations. Fear replaced greed. And markets moved faster on fear. As markets plunged, attention turned to the Federal Reserve. Would it intervene? Rate cuts could stabilize markets, but inflation pressures still lingered. Liquidity injections could calm panic, but risk reigniting speculative bubbles. This is the modern paradox. Central banks must choose between stability and discipline. If they rescued markets too quickly, they encourage future risk-taking. If they wait too long, systemic damage spreads. The AI crash forced policymakers into an uncomfortable spotlight. Beyond charts and indices, real consequences emerged. Tech workers faced layoffs as firms cut costs. Venture-backed startups shut down. Retirement portfolios shrank. Retail investors who entered near the top experienced severe losses. Confidence, once exuberant, evaporated. Markets are not just numbers. They are expectations, and once expectations crack, recovery takes time. Here's the uncomfortable truth. This wasn't just about AI. It followed a familiar pattern. New technology ignites optimism. Capital floods in. Valuations detach from fundamentals. Leverage amplifies gains. A trigger exposes fragility. Panic accelerates losses. We've seen it before in railroads, radio, .com, stocks, housing, crypto. The story changes. The psychology does not. AI did not invent speculation. It simply became its latest vehicle. Was the collapse inevitable? Not necessarily. AI remains transformative. Productivity gains may still materialize over years. But markets price the future, and sometimes, they price perfection. When expectations assume flawless growth, any imperfection becomes catastrophic. The crash was not proof that AI has no value. It was proof that valuation matters. Today's markets are uniquely sensitive because passive investing dominates flows. Algorithms execute trades instantly. Derivatives amplify exposure. Global capital moves at digital speed. When sentiment shifts, the unwind is no longer gradual. It's exponential. The AI crash exposed how quickly optimism can reverse in a hyper-connected system. 3 clear takeaways. 1. Innovation does not eliminate risk. New technology can change the world, but it does not suspend financial gravity. Valuations must align with reality. 2. Leverage turns corrections into crashes. When markets are built on borrowed money and derivatives, small declines cascade into systemic events. 3. Psychology drives cycles more than technology. Booms are powered by belief. Busts are powered by fear. AI was simply the latest narrative. A warning: the next bubble may not look like AI. It may be climate tech, quantum computing, digital currencies. Something we haven't imagined yet. But if leverage builds, valuations detach, and optimism blinds risk assessment, the pattern will repeat. Markets are resilient, but they are not immune to human nature.